Hey everyone, in this video I've got one growth stock that's down 81% off its high that I think makes an excellent addition to investor portfolios today. So I'm going to discuss what this growth stock is and why I'm recommending it and why I like it at current valuation. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the stock I'm recommending today, as of this recording on April 8th, is DocuSign. I'm recommending DocuSign and updating my buy recommendation for DocuSign stock and suggesting it makes an excellent investment at current valuations. I mentioned already that DocuSign stock is down 81% off its highs reached in mid 2021. Of course, DocuSign was more prevalent during the earlier stages of the pandemic when people were looking to avoid close contact with other people. And so signing documents electronically was a no-brainer solution at those times. Not as prevalent today. However, signing documents electronically isn't just a good idea during a pandemic. It's a good idea all the time. Who wants to go in person to sign a document, right? If you could sign a document electronically, would you rather have to drive somewhere to meet in person and sign that same document? I don't think so. I can't see very many instances where that would want to be the case, unless for very important, very critical documents. Of course, that will still be the case, but for usual items that you do on a recurring basis, DocuSign electronic signature just makes a lot of sense. It just makes a lot of sense. Now, DocuSign's not going to take the entire e-signature market, right? It has competitors, and competitors will take market share. The industry overall will continue to grow over the next several years, over the next several decades, until a larger and larger percentage of documents are signed electronically, and only the most vital documents will likely remain requiring in-person signatures. So overall, the industry is likely to grow, and DocuSign is one of the more prominent players in the industry. It generated 2.76 billion in revenue in the trailing 12 months, and that's up from around 700 million in revenue it generated in 2018. So it wasn't like the company's revenue exploded during the pandemic and then crashed back down during economic reopening. It's still up there. Revenue is still high. The growth rate slowed down. That's what happened. During economic reopening, DocuSign's growth rate slowed down. And that's one of the major impacts from the reopening versus during the earlier stages of the pandemic. But the company's overall revenue has remained solid. And you can look at its 2024 fiscal highlights. As I mentioned, total revenue of 2.8 billion. That was up 10% year over year. Billings of 2.9 billion was up 9% year over year. Gross profit margin, of course, being a software-based business, 80% incredible gross profit margins. And then net income per share of 36 cents compared to a loss of 49 cents on the year prior. Not too much shareholder dilution from 201 million to 204 million. And then net income overall per diluted share for the year was $2.98. This is non-GAAP net income, up from $2.03 in the year before. So revenue is growing, profitability is growing. The company turned the corner from losses on the bottom line to profits on the bottom line. And the business model being what it is, those profits are likely to continue going forward. Now, documents operating profit margin over the longer term, you can see it steadily rising from a low of negative 60% up to 2.25% in the most recent trailing 12-month period. I wouldn't be surprised if this continues climbing higher in the double digits, approaching 20%, being that it's a software-based business, and the difficulty in the business is the initial investments in research and development to create this technology. And then from here on out, it's mostly a sales operation, getting your product in front of customers, explaining, getting them to commit, updating the incremental areas that need updating, solving issues customers are having, and iterating on your process. But the big, massive investments were done already, and now it's time to harvest those investments that you made to develop your service. Cash flow from operations also rising nicely, 270 million in the most recent quarter. You can see that up from relatively flat levels in 2018, 2019. So despite the economic reopening, DocuSign has continued increasing its cash flow from operations, increasing its revenue, increasing its profitability, increasing customer count, and on and on I could go. The business has performed well. It's not growing at the rate it was growing during the pandemic, but you shouldn't have expected that. I certainly didn't expect that. I certainly expected a slowdown. I thought maybe revenue would actually decrease in the economic reopening, but it didn't. Revenue continued growing. That was a pleasant surprise from the investors looking at DocuSign stock. And if you look at the next 5 years, analysts on Wall Street that are following DocuSign stock, they expect its earnings per share to grow by 20% per year for the next 5 years. So, and not only has the company delivered robust growth in profitability over the previous few years, but analysts expect solid growth going forward. And one of the key things I look at when I'm considering whether or not an investment is a good value, a good deal, a good bargain, is comparing the 5 year or next few years earnings per share growth estimate to the valuation. If the number in the growth rate is larger than the valuation number, then that signals in most cases that you're getting a good value. So let me show you what I'm talking about. Keep this number in mind here, the 20% earnings per share expectations for the next 5 years, and then look at the valuation. Whether you look at a forward price to earnings ratio of 17 or the price to free cash flow of 14, you're getting larger earnings per share growth at 20 than the number on the valuation, 17 and 14. So in general, that signals you're getting a good value. Now, some specific cases, that's not the case. But in this case, it turns out it is the case, in my opinion, that DocuSign stock offers investors a good value at current valuations, and that stock price decrease down 80% off its high has created an opportunity for long-term investors to scoop up DocuSign stock at attractive valuations. This 81% drawdown, in my opinion, was an overreaction to the slowdown in the growth rate following the economic reopening. As you can see, the bulk of that stock price decrease happened from 2021 to late 2022, and the stock has performed relatively well since then, but it hasn't recovered those losses it experienced from late 2021 to late 2022. Now, it deserved a price decrease because the business was not growing by anywhere near the rates it was growing at during the earlier stages of the pandemic. But the business is still growing by double digits, and profits are growing by double digits. Customer count is growing. The company turned the corner on profitability. And so I think the business deserves a stronger valuation given its stronger metrics going forward. So for all those reasons, I think DocuSign stock is one excellent growth stock that's down 81% that I think makes an excellent addition to investor portfolios today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.